While the first 3 months of 2023 have had significantly more housing demand than we expected coming out of the ice cold fourth quarter, the real story of the year continues to be the restricted supply of homes to meet that demand. Each week, there are 25% fewer new listings hitting the market than a year ago. The question for the rest of the year is whether that demand holds up, or whether the economy turns and uncertainty takes over like it did last fall. We haven't seen any turn yet in the data, but we'll keep watching for it. Every week, of course, Altos Research tracks every home for sale in the country. We analyze all the pricing, the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. The data we cover here in these videos is national in scope, but it is available from Altos for every zip code in the US. If you need to communicate with your buyers and sellers right now, there's a link in the description below to join us. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at the data as of March 27th, 2023. There are 413,000 single-family homes on the market this week across the U.S. That's basically unchanged from last week. Actually, it's a tiny fraction lower. Inventory is really still unchanged for about 3 weeks in a row now. The lowest point was officially 2 weeks ago. In this chart, we're showing the inventory curve for each year. Each line here is a year. The pandemic years are the lines at the bottom. That was both low supply and ravenous demand contributing to that scenario. And you can see how last year inventory started to increase rapidly in the second quarter as mortgage rates rose. That's the light red line. Later in 2022, inventory had a second burst of listings in the fall, which was actually very unusual. And that was a reflection of how dramatically home buyer demand slowed at that time. This year, Q1 has seen significantly more demand than we expected coming into the year. So inventory has fallen from the slow fall. The question for the rest of the year is how quickly, the dark red line here, how quickly it climbs. Does demand weaken again like it did last year? That's going to be the question of the economy. Do we have big job losses coming? Do we have banking crisis or other shocks coming? Even the uncertainty itself is a risk to derailing the housing demand from here. If demand weakens from here, this year's inventory curve will slope up like last year's. If, on the other hand, this year's curve looks more like the other years on this chart, then we will end 2023 with closer to 500,000 homes on the market again. So we'd be staying in this historically incredibly restricted supply story that we've been in for several years. So if the economy tanks hard, then the curve could pick up like last year, pick up quickly. But there's no indication anywhere in the data yet of any surge or that any surge is imminent. So there's no Airbnb bust. There's no investors that are selling or unloading homes. The homeowners in America are not interested in selling yet. The y-axis on this chart isn't zero scaled. It's so we can best illustrate the weekly change in inventory rather than like the absolute distance from zero. The blue line is for 2019. You can see before the pandemic when we had 836,000 single family homes in the market at the end of March. That's twice what it is currently. So plus in 2019, inventory, you can see inventory had been climbing for 7 weeks by this point already in the year. And that's how you can really see the restricted supply story that we're facing right now. And when we look at the volume of new listings each week, you can see how dramatic the shortage is. So since July 4th last year, we've had very few people selling the homes. There's no sign of that changing yet anywhere in the data. This week, only 68,000 new listings hit the market. That's about 16,000, and about 16,000 of those went into contract immediately, our immediate sales tracker. So this chart really shows us supply and demand. Each bar here is the new supply each week. And you can see how every week now is about 25% fewer sellers than last year. Supply is very tight. The light portion of the bar here are the immediate sales each week. So you can think about that as a gauge of demand. So these are the homes that get listed and then purchased right away and go into contract right away. The immediate sales are much smaller than last year too, of course. But you can see that demand is bigger than last fall. So it's just no comparison to last spring when buyers were still rushing to get every deal done they could while rates were on the rise. So 2 things to look out for here with this chart. If you are expecting weakening housing market this year, you'll want to watch supply and demand. Last fall showed us demand can grind to a halt even when we still have very little supply. But also, if we get to a point in the economy where people, especially investors, are unloading their properties, then we will see supply finally start climbing. The bars each week here, the total bar would be getting taller in that case. The investors own a ton of properties in the U.S. And so those could indeed add to inventory later in the year or maybe 2024. We've been watching for this to happen for like 24 months now, and it hasn't happened yet. But it could. And so look for that change in this chart here. Look for the light colored part of the bar to shrink if demand weakens dramatically like it did last fall. So you can see both of those elements in this chart. Meanwhile, spring home prices are ticking up slowly each week. The median price of all homes on the market in the U.S. right now is $433,000. If you walk into the market today, this is what you'll see. And it's actually a little higher than it was last year. But these are for transactions that would happen in the future. The price of the new listings this week is $409,000. And that's flat from last year at this time. The price of the new listings reflects that sellers and listing agents know exactly where demand is in their local markets, and they price in aggregate exactly at the selling point. So the price of the new listings ticked up 2% this week. And last year, though, you can see the light red was sprinting higher each week and at the tail end of the pandemic boom. So year-over-year comparisons continue to look unfavorable, like we are flat or down a little bit at the price of the new listings from last year. And the headlines will continue to report negative year-over-year home pricing changes for the next several months. If you're looking, though, to tie these leading indicators of pricing most directly to the sales price, the one that you hear in the headlines, it's useful to look at the pendings. So the pendings, these are the homes that are in contract and that will close. The transaction will close. The sale will happen in the next month or two. The median price of the pendings is $375,000, which is 1% lower than last year at this time. This is going to widen in the next few months too. You can see how the pendings price last year, the light red line, kept climbing pretty steeply until May. So even though home prices aren't falling right now, the year-over-year difference is going to continue to widen. The headlines will exaggerate that decline from last year because the final sales price last year included a lot of overbidding. And so that overbidding is largely gone. So the difference between last year and this year will grow as well. So we've been talking about for 9 or 10 months about how home prices for 2023 will be flat or down. And so that moment is now upon us. We can see the transactions that are happening now are happening at about 1% or more below last year at this time. So though like we saw last year that today's state we saw last year coming, now it looks like another big economic shock like recession or job losses will have to hit before the home prices take another step down. We hit demand back down with some other economic change. As I've mentioned, we in this moment where it's sort of like the beginning of last year when we expect the market to slow, but it hasn't slowed yet. Last year, we kept looking for rising inventory and rising price reductions, both of which had hit record lows during the pandemic. This year, price reductions are not at record lows. They're on the high side, just on the high side of normal. So just over 30% of the demand of the homes on the market have taken a price cut as of this week. And that's, see the dark red line here, the curve for this year. Now, if recession or banking crisis or job losses hit, like, we saw the big change in housing demand last year, we'll see sellers have to cut their prices like we saw. A year ago in March, we could just see the market starting to cool compared to 2021. And that cooling really accelerated in April. See the light red line lift off the bottom there? This is a really leading indicator of future transactions. And as of right now, though, the trend is opposite what it was last March. So price reductions are not yet accelerating because this is, supply is tight and demand has been surprisingly resilient. So again, we're going to be highly sensitive to market conditions changing. Will home prices turn south again? And if they do, we'll see it here very quickly, like we did in March and April last year, at that moment when it finally happens. So if the economy and financial markets, it's really those that we need to keep our eyes on. So if you need to know what's happening in your local market, go to altosresearch.com, book a free consult with our team, and we'll help you interpret the crazy market for your clients, your buyers and sellers right now. This is a critical time to be informed about the market, so please join us. All right, more next week.